Silver just shattered every expectation on Earth. $58 per ounce, a new all-time high. And if you think that's wild, then you need to hear what comes next, because $100 silver isn't hype. It's math. It's inevitability. It's already in motion. Here's what almost nobody understands. While the world was hypnotized by Bitcoin, AI stocks, and the usual noise, silver quietly doubled in 2025. From $29 in January to $58 today. Not speculation. Not prediction. Reality. But the crazy part? The move to $100 isn't even the real story. The real story is that silver is finally breaking free from a system that has kept it artificially cheap for decades. And now the dam has burst. Let's start with the truth almost no one knows. Silver has been in a supply deficit for 6 straight years. Every year since 2019, we've used more silver than we mined. In 2025, the deficit is projected to hit 117.6 million ounces. That's nearly 15% of total annual mine supply. Gone. In a normal market, prices would explode. But silver didn't move. Why? Because for decades, big banks, especially JP Morgan, kept silver prices suppressed with massive paper shorts. They created synthetic silver from nothing and dumped it into the futures market to keep the real price down. But in 2025, everything changed. Physical demand broke the paper market. Real buyers want real metal, not promises, not contracts, not digital IOUs. And this shift has caused a chain reaction. Shanghai silver warehouses are at their lowest inventory levels in 10 years. London just saw a record metal flow into vaults, tightening global supply. Silver-backed ETFs added 200 tons in 24 hours, the biggest inflow since 2022. This is what a physical squeeze looks like, when demand hits reality, and reality can't keep up. Now let us break down the 8 forces that are carrying silver straight toward $100 and beyond. Reason number 1. The gold to silver ratio is broken. The current ratio sits around 73 to 1, meaning 1 ounce of gold costs 73 ounces of silver. Historically, the ratio averages 50 to 1. In ancient times, 15 to 1, because that's roughly how much exists in the Earth's crust. At today's gold price of around $4,200, at 50 to 1 gives silver equals $84. At 40 to 1 gives silver equals $105. At 30 to 1 gives silver equals $140. Silver always outruns gold in bull markets. It's more volatile, smaller, and turbocharged by industrial demand. Reason number 2. Industrial demand is exploding. Silver isn't just money. It is technology. The modern world literally can't function without it. The biggest catalyst? Solar panels. Every solar panel requires silver, and nothing else conducts like it. Solar capacity is expected to triple between 2023 and 2030. The industry already consumes over 100 million ounces yearly, and demand is growing 15 to 20% per year. Then add electric vehicles, which use double the silver of gas cars, 5G infrastructure, which requires far more silver than 4G, medical devices, disinfectants, hospital equipment, consumer electronics, laptops, phones, appliances, AI hardware, data centers, robotics, all silver heavy. Industrial demand isn't leveling off. It's launching. And remember, this is happening during a supply deficit. Reason number 3. Investors are waking up. For years, silver was ignored. Now, physical dealers are reporting shortages. Premiums on silver coins are spiking. Some products have weeks-long wait times. ETFs are absorbing metal at a pace not seen since 2020. Here's the mind-blowing part. The entire above-ground investment-grade silver supply is around 2 to 3 billion ounces. That's tiny. Meanwhile, gold has 6 billion ounces in investment form. At today's prices, total silver investment market approximately equals $150 billion. Total gold investment market approximately equals $15 trillion. Silver is 1% the size of the gold market. If even a fraction of gold money rotates into silver, the price has to skyrocket. Reason number 4. The dollar is losing its grip. As countries move away from the US dollar, they rush into hard assets. Central banks are loading up on gold, but quietly, some are accumulating silver too. If just 1% of global central bank reserves moved into silver, that alone would require hundreds of billions in demand, hitting a market worth only $150 billion. The math forces prices higher. Reason number 5. Mining supply is stagnant. Silver mining peaked years ago. We aren't finding new discoveries fast enough. And most silver is produced as a byproduct of copper, zinc, and lead mining, meaning higher silver prices don't automatically increase production. The Silver Institute expects only 1 to 2% growth in supply for 2025 and 2026, but demand requires 15 to 20% growth just to break even. New mines take 7 to 10 years to develop. The supply crunch is baked in. Every major central bank on Earth has been printing money like it's oxygen. That destroys purchasing power, and when people panic, they flee into hard assets. Gold is the traditional refuge, but silver is the accessible refuge. At $58 an ounce, it's the inflation hedge that normal people can actually afford. And unlike gold, silver has something gold will never have: massive industrial demand. That gives silver 2 engines: a monetary engine, a technological engine. In an inflationary world, dual-engine assets outperform everything. Reason number 7. The technical breakout is violent. Silver spent nearly 2 decades trapped between $15 and $30. That wasn't a price range. It was a compression chamber. Once it broke above $30, momentum kicked in. Once it reclaimed and destroyed the 2011 high of $49, the entire chart flipped bullish. Now at $58, silver has no overhead resistance. We are in pure price discovery. Technical analysts see the long-term base as a $35 range. Apply that to the breakout level, and you get targets well over $100, $120. Uptrend confirmed. Momentum rising. Volume surging. Dips getting instantly bought. This isn't speculation. It's textbook breakout behavior. Reason number 8. The short squeeze setup is nuclear. There are still massive short positions in the silver futures market, but now the shorts are bleeding. As prices rise, they face margin calls. When they buy to cover, the squeeze intensifies. This is the same dynamic that sent stocks like GameStop into the stratosphere. Except silver is a real physical commodity. You can print shares. You cannot print silver. If a major short fails to deliver metal in a tight supply environment, the price can go vertical. And right now, the supply is the tightest it's been in a generation. A real squeeze could send silver to $100 in weeks, not years. Now, let's talk about risks and why the upside still dominates. Skeptics say silver has been hyped for decades. Fair. But the fundamentals have never looked like this. 6 straight years of deficits. Record industrial demand, ETF inflows spiking, global inventories thinning out, technicals aligning, central banks shifting into hard assets. This is not the same setup as 1980 or 2011. This is stronger. Could a severe recession slow industrial demand? Yes, but recessions trigger money printing, which boosts precious metals. Could new technology replace silver? Not anytime soon. After decades of research, nothing matches silver's conductivity or performance at scale. Could governments restrict ownership? Unlikely. Silver is too crucial for electronics, medicine, and industry. Bottom line, the downside risk is limited. The upside is massive. How to play this move. 1. Physical silver. Best for most people. Coins and bars remove all counterparty risk. American Eagles, Maple Leafs, Philharmonics, all excellent. Premiums rise during bull markets, so buying earlier saves you money. 2. ETFs. SLV, PSLV. Fast, liquid, easy to trade. PSLV is preferred by many because it's fully allocated. 3. Miners. High risk, high reward. If silver hits 100, miners can 2x, 3x or more, but they come with operational risks. A balanced approach: 70% physical, 30% miners. Price targets and timeline: Q1 2026. Consolidation between $55, $70. Q2 2026. Breakout to $85, $90. Q3 2026. First touch of $100. Q4 2026. Either consolidation or a mania run to $120, $150. Could it happen sooner? Yes. Could it take longer? Also yes. But the direction is unmistakable. The psychological trap: when silver starts making 10% swings daily, weak hands will panic. They'll buy late, sell early, get shaken out. You avoid that by understanding the fundamentals now, before the mania. Final message: silver at $58 is a gift. A temporary window. A once-per-decade setup. You will look back at this moment a year from now and either say, "I'm glad I acted," or "I hesitated and missed it." I know which one I choose.